Welcome to this explainer. Today, we're diving into the hidden costs of simply holding your crypto and, more importantly, how to fix the 5 biggest mistakes investors make. Most folks think buying and locking away assets like Bitcoin or Ethereum is the ultimate path to success. But as you'll see, hodling is really only half the story. It all starts with a simple yet absolutely critical question. Is your portfolio actually working for you? Or is it literally just sitting there gathering digital dust? Assuming a cold wallet is the finish line might actually be costing you thousands in missed opportunities. Millions of investors buy their assets, lock them away, and just kind of hope for the best. But is that really enough? Let's find out. First up, let's talk about the hidden cost of holding. Mistake number 1, letting your idle assets earn absolutely nothing while you wait for the price to go up. Think about your cash for a second. You wouldn't stuff tens of thousands of dollars under a mattress when it could be earning daily interest in a high-yield savings account, right? I mean, no way. Yet when it comes to digital assets, millions of us do exactly that. We leave them in a wallet where they generate absolutely zero. When your assets are completely unproductive, you are missing out on an entirely different layer of growth. It's like leaving money on the table. To put that into perspective, imagine holding 50 grand worth of Bitcoin or Ethereum for an entire year. 365 days pass, and you haven't earned a single dollar beyond price appreciation. It just sits there doing nothing. When you frame it with real numbers like 50 grand, the massive opportunity cost becomes impossible to ignore, doesn't it? But hey, the fix here is actually pretty simple. You don't have to lock your assets away forever to see a return. By exploring trusted platforms, eligible users can actually earn yield on their crypto while still keeping the flexibility to access funds when needed. It's really all about making your portfolio productive instead of passive. Okay, moving on to mistake number 2, the crypto liquidity trap. Look, life happens, right? Unexpected expenses pop up out of nowhere. But if your knee-jerk reaction is to sell off part of your portfolio to raise cash, you are stepping right into a trap. Not only do you lose out on future growth if the market rallies the next day, but that quick reactive sale could also slap you with a frustrating capital gains tax bill, depending on your local laws. Talk about a double whammy. Experienced investors, they sidestep this entirely. They utilize tools that provide immediate, short-term cash without forcing them to permanently give up ownership of their valuable assets. They get the liquidity they need without sacrificing their long-term position. It's a real game changer. Which brings us to mistake number 3, and the solution: smarter crypto borrowing. Now, I know what you're thinking. A lot of folks avoid crypto-backed loans entirely out of one totally valid fear: liquidation. If the market takes a sudden, violent dive and your loan isn't managed properly, your collateral could automatically be sold. It's a harsh reality of the market, and it understandably keeps a lot of investors strictly on the sidelines. But you can absolutely protect yourself. The secret is choosing financial products built with conservative structures and crystal clear terms. By taking the time to set this up correctly before jumping in, you insulate yourself from sudden market shocks and drastically reduce that uncertainty. And that flows right into mistake number 4, starting from scratch every single time you need funds. Going through the hassle of submitting documents and rebuilding collateral over and over is just exhausting. Modern platforms solve this by letting you seamlessly renew or extend your arrangements. This completely bypasses the repetitive paperwork and makes long-term liquidity management actually convenient. Finally, let's look at mistake number 5, the ultimate mistake: holding your crypto with no real strategy. Buying a coin just because you believe in its future is literally just step 1. Successful investors build a master plan. They know exactly how they'll secure their assets, they have target levels to take profits, they actively manage their risk, they plan for liquidity emergencies, and above all, they make their portfolio actively work for them rather than just sitting back and waiting. Because without a comprehensive strategy like that, emotions take the wheel. And as the old saying goes, emotional investing rarely ends well. Long-term success requires making informed decisions, not just reacting with panic or greed to whatever the market happens to be doing on any given day. Now, I have to say this: all financial tools come with risks. Your absolute best defense is deep knowledge. So always do your own research, deeply understand the mechanisms you're using, and never, ever invest more than you can comfortably afford to lose. Whether you choose to earn yield, borrow, or just keep everything locked safely in cold storage, being informed is for sure your greatest asset. So, as we wrap up this explainer, I want to leave you with this final thought. You already know how to buy the asset. But do you actually have a plan in place for before you need one? The tools to fix these costly mistakes are out there. You just have to use them. Take a hard look at your portfolio today. Is it working for you, or are you just waiting? Thanks so much for joining me.